Welcome to this episode of PhillipCapital's Market Watch. My name is John Chu, CFD Dealer at Phillip Securities. Singapore's three largest banks, DBS, OCBC and UOB, are trading at record highs in 2025. Together, they account for nearly 40% of Straits Times Index, making them key drivers of the market. Following this rally, their fundamentals are starting to diverge. In today's session, we'll dive into their profitability, margins, dividends, and the risks ahead. Let's dive right in. DBS surged almost 49% in the last year, while OCBC and UOB each gained around 21%. The rally was fueled by record profits in 2024, supported by higher interest rates. However, Q2 2025 tells a different story. DBS generated a steady profit of $2.82 billion, beating estimates. OCBC's profit fell 7% to $1.82 billion, while UOB declined 6% to $1.34 billion. This shows that the boost from higher interest rates is fading, and not all banks are navigating the shift equally well. Next, let's take a look at profitability. DBS delivered a record profit of $11.4 billion last year, with a strong return on equity above 17%. While UOB's profit have remained stable, its ROE is lowered at around 12%. OCBC sits in the middle with an ROE at about 13%, though its profit growth has been more cautious. Overall, DBS has consistently demonstrated its ability to generate higher returns from its capital compared to its peers. Margins, however, are becoming the pressure point. In Q2, DBS net interest margin slipped to 2.05%. OCBC came in at 1.92%, with a full-year guidance revised lower, while UOB reported 1.91% and also trimmed its outlook. As interest rates decline, growth in net interest income will slow, making it clear that the golden boost of 2024 is now behind us. For investors, payouts remain a key focus. DBS has raised its quarterly dividend to 75 cents and is executing a $3 billion share buyback. UOB announced its own $3 billion package, combining a special dividend with share repurchases. OCBC has taken a more cautious approach, declaring an interim dividend of 41 cents and committing up to $1.87 billion over 2 years. This positions DBS as a standout for aggressive shareholder rewards, UOB as appealing to income-focused investors, and OCBC as maintaining a more conservative stance. The three banks are also diverging in their strategies. At DBS, CEO Tan Su Shan is emphasizing bolt-on acquisitions while accelerating investment in digital capabilities and artificial intelligence. UOB is doubling down on its ASEAN expansion, aiming to build scale and diversify earnings by strengthening its fee-based businesses. Meanwhile, OCBC has trimmed its 2025 outlook and is preparing for a leadership transition at the end of the year, which adds an element of uncertainty of its execution. Now, what about risks? There are three key themes to watch. Firstly, there is margin compression. Net interest margins are narrowing as global interest rates decline and competition for deposit intensifies, capping profit growth across all three banks. Secondly, watch out for macroeconomic headwinds. Slower recovery in China, potential US rate cuts, and renewed trade tensions could dampen loan demand and fee income. OCBC and UOB, which have greater exposure to ASEAN trade, may feel this more sharply. Last but not least, there is a leadership transition. DBS is undergoing a significant change, with Ms. Tan Su Shan taking over after the long-serving CEO PYTCH Gupta left in May. While she is well-regarded, transitions inevitably carry execution risks. That said, all three banks remain financially resilient. CET1 capital ratios are above 14%, comfortably exceeding the MAS requirements. In addition, the banks are investing in long-term growth drivers such as wealth management, sustainable finance, digital banking, which can help offset slower lending growth. So, Singapore banks are at all-time highs, but their paths forward are diverging. The question is, which one fits your portfolio? Share your thoughts below. That's all for this episode of PhillipCapital's Market Watch. Remember to like, share, and subscribe for more investing insights. Thanks for watching.